Good afternoon, students. Today we are going to see the canon of taxation. What is taxation? The most important source of revenue of the government is taxes. The act of levying taxes is called taxation. A tax is a compulsory charge of fees imposed by government on individuals or corporation. The person who are taxed have to pay the taxes irrespective of any corresponding return from the goods or services by the government. The taxes may be imposed on the income and wealth of person or corporation, and the rate of taxes may vary. The objectives of taxes are raising revenue, regulation of consumption and production, encouraging domestic industries, stimulating investment, reducing income inequalities, promoting economic growth, development of backward region, ensuring price stability. Taxes can be classified into two types, direct taxes and the indirect taxes. In the direct taxes, a direct tax is a tax whose burden is borne by the same person on whom it is levied. The ultimate burden of taxation falls on the person on whom the tax is levied. It is based on the income and property of a person. So the direct tax is divided into five heads: corporation tax, income tax, wealth tax, gift tax, and the property tax. The meaning of indirect taxes: it is a tax which is initially paid by one individual, but the burden of which is passed over to some other individual who is ultimately bear it. It is levied on the expenditure of a person. The indirect taxes are excise duty, sales tax, custom duty, VAT, that is value added tax, GST, goods and service tax. The meaning of canon of taxation. By canon of taxation, we simply mean the characteristics or the quality which a good tax system should possess. In fact, canons of taxation are related to the administrative part of a tax. Adam Smith first devised the principles or canon of taxation in 1776. Even in the 21st century, Smithian canon of taxations are applied by the modern government while imposing and collecting tax. The types of canon of taxations are it is a classical in sense four canon of taxation: canon of equality, canon of certainty, canon of economy, and canon of convenience. Modern economics has more divided into again the canon of taxation are canon of productivity, canon of electricity, canon of simplicity, and canon of diversity. The canon of equality is the state that the burden of taxation must be distributed equally among the taxpayer. If anyone is asked to pay taxes according to his ability, then the sacrifice of all taxpayer become equal. This is the essence of canon of equality. In other ways, the equality, the meaning is sacrifice. Rich people are capable of paying more tax than poor people. Thus, justice demands that a person having greater ability to pay must pay large taxes. The canon of certainty. The tax which an individual has to pay should be certain and not arbitrate. According to Adam Smith, the time of payment, the manner of payment, the quantity to be paid, that is tax liability, oath, all to be clear and plain to the contributor and the everyone. The canon of certainty embraces a lot of things. It must be certain to the taxpayer as well as to the tax levying authority. Next, the canon of economy. This canon implies that the cost of collecting a tax should be as a minimum as possible. Any tax that involves high administrative cost and unusual delay in assessment and high collection of tax should be avoided together. canon of convenience. We now present other canon of taxation, that is canon of productivity. According to a well-known classical economist in the field of public finance, Charles, taxes must be the productive or cost effective. A tax is said to be a productive one only when it is act as an incentive to the production. The canon of elasticity. Modern economists attach great importance to the canon of elasticity. Canon of simplicity. Every tax must be simple and intelligible to the people so that the taxpayer is able to calculate it without taking the help of tax consultant. Thank you.